Welcome back to the Breakfast Daily, where each day we take a look at where home loan interest rates really are, what is making them move, and what we expect for the future. Today is it is March the 22nd, 2023. It is now 3:11 p.m. Central Time, and the Federal Reserve has increased the federal funds rate by 0.25%, bringing the federal funds rate to the approximately 5% and the prime rate to 8%. Now, the prime rate I don't talk about very much, but the federal funds rate is directly tied to the prime rate. And the prime rate is the rate that is used to calculate the interest on most cards, most home equity lines of credit, and many auto loans as well. So these things directly affect you and I. Now, what they don't directly affect is home loan interest rates. Mortgage interest rates are not tied to the prime rate or the federal funds rate. In fact, we often see that when they increase the federal funds rate, that brings home loan interest rates down. And we're going to take a look at that in just a moment. Now, the Federal Reserve had a very difficult job today, and we were all very curious as to what they were going to do because they're trying to balance two things that are going to be affected by the federal funds rate. First, they're trying to bring down inflation. And we've talked about that now for months, that the Federal Reserve has been increasing the federal funds rate to try to slow the economy and bring inflation under control, which is good. Inflation is the enemy of home loan interest rates. So when inflation goes up, home loan interest rates go up. That's why interest rates have been dancing between 6 and 7%. When the inflation comes back down, home loan interest rates can come down as well, along with the 10-year treasury. Great. But when the Federal Reserve increases the federal funds rate, it increases the cost of borrowing. And that includes the cost of borrowing to banks. That is directly actually how banks borrow money back and forth, is based on the federal funds rate. So when all of a sudden it becomes more expensive to borrow money, that really hurts banks' ability to do business. When you see the yields coming in higher on treasuries and bonds and things like that, it also lessens the value of the assets that they are currently holding. So this is not good for banks. They do not like to see this happening. And some banks are over leveraged. They've leveraged themselves to the point that the changes that the Federal Reserve has made has really affected me to the point that they almost can't do business, such as Silicon Valley Bank and Signature Bank. Some of the other banks, they're getting close, but banks are coming to their rescue. The Fed is coming to their rescue, trying to stabilize the banking industry. We need a stable banking industry while we bring down inflation. And that is very difficult because usually they work like this. If you bring down inflation by jacking up the federal funds rate, it is painful to the banking industry. So how do you set it up like this? Well, in this case, the Fed is basically using two different hands. Like I was just showing like this right here. They go, well, we're going to bring up the federal funds rate, but then we're going to make more cash available to the banks to keep them liquid. Anyway, we're not going to get as deep into that. Let's take a look and see how the increase to the federal funds rate of 0.25% is helping us. Now, before I jump over there, I want to make sure that we take a quick look at the article here that came out. It said Fed hikes 1/4 point. It indicates increases are near an end. That is the key. That is what we should be excited about. For the first time, Jerome Powell mentioned that the increases to the federal funds rate are near an end, which only would mean that they're starting to see inflation subsiding and that the effects of the moves that they have already made are actually taking hold. This is what we want to see. So let's take a look and see what is going on with our mortgage-backed securities. Okay, so we're currently up 42 basis points. Look at the 10-year treasury down 16 basis points. That's a big drop on the 10-year treasury. I did see the mortgage-backed security up over 50 today, so we have come back a little bit. Well, let's jump back over to our charts and see why it would have come back down from 50. Well, what do you know? Guess what's up here about 50? The 200-day moving average. So the very difficult to break 200-day moving average is what we just about banged up on. We came back down. Right now, we're up 42 basis points. Still a very good day. And look at these big green numbers from yesterday's numbers. And understand, here's the other thing, is that this is still knee-jerk reaction, okay? So as things are digested, the market is going to move further in one way or pull back from where it came from. I think that from what I have seen so far, and especially hearing Jerome Powell say that we are near the ends of the increases to the federal funds rate, I think that the bond market, the treasury market, and the mortgage-backed security market is going to really like this as we move forward. And I'll show you that there's some other people that agree with me here in just a minute. So let's take a look here. Again, this is the mortgage-backed security chart banging up against the 200-day moving average. And let's not forget where we came from, guys. Let's not forget that we were down here and we looked up at all of this turbulence that we had to get through. Well, we're through it and we're convincingly through it. We have been for a while now. Okay, so now we're banging up against the 200-day moving average. We're going to be rolling over into the personal consumption expenditures report coming out on March the 30th. We'll see how that comes in and then roll into a fresh set of numbers in the month of April, which I think we'll have to look further into that data because there could be a blip in the month of April, but then we're going to get through it. And I think from then on, it's going to be some smooth sailing, but I'll talk to you more about that in April. Take a look at the 10-year treasury as well, because I want to show you the charts and the floors and ceilings that we're getting through. Now, here that is. Now, remember, the 10-year treasury, we want to go down. We don't want to go up. So when you see it breaking convincingly below the 200-day moving average and banging off a Fibonacci level below the 200-day moving average, very good, guys. Very good indicator of things to come in the near future. Well, how is that conveying over to home loan interest rates? Let's take a look and see what's going on with the Brent Bruce Daily, our very well qualified 30-year fixed conventional, 25% down, 800 FICO score. Primary residence, single family residence, the best of the best, right? Well, let's take a look and see where we are after a wonderful day. Now look at up only 36, guys. We were up 51 a minute ago, pulling back a little bit. I did see, by the way, there were multiple intraday reprices. So as the market rallied, we were getting intraday reprices, giving us better and better interest rates throughout the day, but they can also turn around right now and take them back. This happens throughout the day. You have to make sure that you understand that. So right now we're at 6.375 with a couple of banks. This is 11, Flagstar, United. Let's take a look. 6.375 with a 925 credit. That's helpful. But an eighth really isn't that exciting. I like to see us under 6.5 because we haven't been for a while. But I would like to see something more than that. And I know that the banks are holding back because they're not sure what the market is going to do in the next few days and how they digest the information. So the mortgage banks do have profit right now. They have gain, but they're not quite ready to hand it over because what if tomorrow everyone turns around and takes back those gains? That's what they're always watching out for. But I think we're going to actually be okay tomorrow. Let's take a look and see what if you were to want to pay a little bit of points. What does it take to get to that 5.999 that we always talk about? Let's take a look at 11 mortgage here at the very top of the list today. So 5.999 is going to cost 0.58. Okay, so a half of a point, you're at 5.99. But earlier today, I was looking at 11 mortgage as the new rate sheets came out, and it looks to me like for 5.999 is only costing 0.2, $731. Guys, here we are. Okay, we were so upset, 6.875, trying to stay away from a 7.0 number again, 2 weeks ago. And now I'm telling you that for 0.2, so less than a quarter of a point, I'm going to get you a 5.99. Now understand, we don't want to get into this in detail, but that means that I can do a 2-1 buy down right now on a conventional loan offering a 3.99% first year payment rate with only 0.2 in cost. If you want to know how to do that, you got to get with me and talk further into it because I have not seen a single other mortgage banker or broker that is telling you how 2-1 buy downs actually work. It does not reduce your interest rate. So you should make sure to talk to me about that. Make sure that if you have any clients that are interested in working with me, reach out to me, guys. Give me a call, shoot me a text, have a client give me a call. My information is always down below. Make sure that you like, subscribe, and share. And I'm going to give you more information. We're going to follow and see how this flows through after today's announcement, after the information is digested, and how the markets really take it in the next couple of days. But I will tell you that for raising the federal funds rate by 0.25% amongst massive turmoil in the banking industry, the fact that the Fed and Jerome Powell did say that we see the end is near and that we probably will only increase the federal funds rate by another 0.25% is exactly well played. I think that is well played. I think that's going to be good for home loan interest rates. I think that's going to be good for the bond market. Right now, the stock market is not liking it. Right now, the stock market is down 500, but I do think that's going to rebound in the coming days as they kind of see that this is a good situation. Let me know what you think. Let me know your thoughts. Make sure that you like, subscribe, and share. I will see you again tomorrow.